Welcome back to our market coverage. Let me walk you through what was an extraordinary session across global markets. The Nasdaq closed at 25169, down nearly 2%. The S&P 500 lost 1.62%, and the Dow dropped 1.87%. But the real story is in the cross currents. The VIX Volatility Index surged over 11% to 22.22, yet the 10-year Treasury yield actually rose to 4.54%. That is not a classic risk-off move. In a normal flight to safety, bond yields fall as prices rise. What we are seeing here is something more dangerous. It looks like a liquidity panic combined with a supply shock. Investors are not just buying treasuries for safety. They are being forced to sell everything else to raise cash, and they are piling into commodities, especially crude oil. Speaking of crude, WTI surged over 5% to $92.64 a barrel. Brent crude rose 4.5% to $95.45. That is a massive move in a single session. And here is where it gets really interesting. Gold, which is supposed to be a safe haven, plunged over 3% to $4,084. That divergence between oil and gold is extremely unusual. Our analysis suggests that investors are being forced to liquidate gold positions to meet margin calls on other volatile assets. So the money is flowing out of tech stocks and out of gold, and it is flowing into cash and into crude oil. This is not a normal risk-off trade. This is a panic repricing of risk based on fears of a supply disruption. Let us break down the day region by region. In Asia, the Chinese market showed significant divergence. The Shanghai Composite fell only 0.42%, but the Shenzhen Index dropped over 2% and the Chinext Board lost 2.7%. Interestingly, the Shanghai 50 Index actually rose 0.27%. That tells us domestic money is rotating into high-dividend blue chips for safety. The A-share market did not fully follow the panic we saw in U.S. futures. European session data is missing from our report, so we cannot confirm whether Europe amplified or absorbed the bearish sentiment from Asia. That is a gap in our analysis. But the U.S. session was crystal clear. Equities opened lower and never recovered. The QQQ Tech ETF fell 1.84%. Nvidia dropped nearly 3%. Tesla lost over 3.6%. Tech growth leaders were the main target of selling. And the VIX continued to climb even after the closing bell, which tells us the selling pressure has not dissipated. Now let us talk about the biggest surprises today. Our morning briefing called for a choppy, slightly bearish session. We were wrong. The market delivered a one-sided panic with a supply shock. We significantly underestimated the VIX surge and the Treasury yield move. The single biggest surprise was the crude oil spike of over 5% and the simultaneous collapse in gold. The market is pricing a supply shock and inflation, not a recession. Another massive red flag was the Treasury yield. In a traditional risk-off environment, yields fall as investors buy bonds. Today yields rose. That means the market is ignoring treasuries as a safe haven. That is a huge anomaly and our morning briefing did not flag it. Looking at the dollar and the yuan, the dollar index edged up to 100.08, a very modest gain. The dollar did not surge despite the VIX spike. The yuan held relatively steady at 6.78 against the dollar. That tells us the panic is not about a broad dollar safe haven move. It is specifically about oil. This also suggests emerging market stress may remain manageable for now. The A-share market fell far less than U.S. equities, confirming that China is acting as a relative safe harbor rather than an amplifier of panic. But the weakness in the Shenzhen and Chinext indices shows that growth stocks remain fragile. What are the main money flows? The strongest direction is clearly crude oil and energy stocks. The second strongest is cash and the dollar. The weakest direction is U.S. tech stocks, especially the QQQ, Nvidia, and the ARK Innovation Fund. These are the assets being drained of liquidity. For tomorrow, we have several verifiable predictions. First, crude oil will likely trade in a high range between $90 and $95. If Asian session prices stabilize below 92, that would signal relief. If they break above 94, that signals escalation. Second, the Shanghai Composite is expected to open lower and then trade in a range of 39.50 to 40.20. Watch whether the Shanghai 50 continues to outperform the Chi-Next board. Third, Nasdaq futures will face strong resistance to any rebound. If pre-market futures cannot recover above 25500, that is a bearish sign. Fourth, the 10-year Treasury yield will likely stay elevated between 4.5 and 4.6%. If it falls below 4.45, that would signal a return to safe haven buying and would be positive for equities. In summary, the core narrative today is supply shock and inflation expectations, not recession and risk aversion. Our probability assessment for tomorrow is 15% for an up day, 35% for a choppy session, and 50% for further downside. The recommended strategy is to hedge or stay in cash. If crude oil stabilizes below $90 in Asian trading tomorrow, you could consider a small long-short hedge. But if crude surges another 3% or more, move fully into cash. The all-clear signal will come when the VIX falls back below 20 and the 10-year yield drops below 4.4%. Until then, caution is the watchword. The market has not yet chosen a clear direction, and the risk of further panic remains high. Stay disciplined and protect your capital.